Let's work through some exercises in Chapter 8. I would say about this that it'd probably be a good idea if you stopped and did a printout of the PowerPoints for these exercises, because as I go through them you aren't always able to see the descriptives by the solutions. I can talk through it, but it's probably best if you would print out this PowerPoint slides and then go back and listen to this as we work our way through it. In this first exercises, we have to complete the table by computing missing amounts. And the main thing is this is taking us back to a slide we had in this chapter. It showed us that the way you calculate interest is by taking the principal times the interest rate times the period in months, and then the period in months, the denominator needs to be 12. So in the first one it'd be 100,000 times 10% times 6/12 to get the interest that would be earned. And this is the interest that they would earn for the total time period, or for the total time to the maturity value of the note. So in the first one you can say that this is going to be 6/12 or half for the time period, and you're going to see it's 10%, and 10% of 100 would be 10,000, and then half of that from the 6/12 would be 5,000, and multiply across. So that's 5,000. Now, it's a matter of algebra. A lot of what we do in accounting is algebra. Some people say, well, you're adding, multiplying, and dividing, and I say it's a little more complicated than that. We use algebra an awful lot. So in case B, you're going to multiply 50,000 times some number times 9/12 and end up with 3,000. So sometimes it's easier to write it out as an algebraic equation and then solve for, in this case, the question mark. And if you do it, you'll end up doing something like this, 3,000, and then that's on the right-hand side of the equation. Divide that by the numbers on the left-hand side of the equation, which is 50,000 times 9/12, and you end up with 8%. And remember also that 8% is what numerically? 0.08. Okay, so you have to do have to recall that. Likewise, if you go down to C, you're going to divide the 4,000 by, this is 1, isn't it? 12/12 is 1. So really 4,000 is going to be divided by 10% to get some number, and you can almost do that in your head and come up with 40,000. Okay, so the main point in this exercise is for you to understand it is principal times interest rate, which is for an annual time period. I said almost always in accounting. And then the time period we're going to calculate it based on months. The next problem then is on bad debt expense, and we're going to use the aging of accounts receivable. So this is an example, and it's better if you have all your slides in front of you when we work through it, because you're going to have a schedule which is going to show the amounts of total accounts receivable balance that are each one of the buckets. So current to 30 days unpaid is 12,000 in there. The next one, which goes up to 90 days, is 5,000. Now, sometimes the buckets are broken up differently. It's more common to say, instead of 31 to 90, 31 to 60, and then 61 to 90, and have another bucket. This particular problem, they divided it into 3 major buckets. You could have 4, you could have 5. It just really, the whole point here is you want to come up with a methodology that really reflects what's happening for your business. So you're coming up with these percentages and you're using the buckets to scientifically come up with the best estimate of what's going to be uncollectible. This company says it's okay for them to put 31 to 90 days in one bucket and they get good results, so that's the way they're doing it. Now, we also know that there's an average loss rate that we have seen. They have seen this in looking at their accounts. 5% for the more recent accounts, the ones that customers are paying off on time or close to on time, 10% for that next bucket, and 20% for the more delinquent accounts. So they want us to prepare a schedule, and then they have to do a recording of bad debt, and then talking about how much is in bad debt expense. So your first part is just going through, and they don't have it listed here, but this is the total accounts receivable of $20,000, and this is where they have put it into the buckets. And multiplying that gets us a total amount which we believe should be the amount of our accounts receivable that we don't expect to collect on. So if this is the amount that we should have in our uncollectible account balance, which is our allowance account, we have to go in and we have to figure out what we need to put in there to make it $1,700. If our balance is $800 now and we need for it to be $1,700, then we're going to have to put $900 in, and when we do our journal entry, it's going to be allowance for doubtful accounts is going to be credited for $900, and bad debt expense is going to be debited for $900. Now, the last requirement of this problem says, well, what if instead of having an existing credit balance of $800, we had a debit balance of $600? If you had a debit balance of $600 and you need to end up with $1,700 as a credit balance, you have to remove the debit. So you would credit the allowance for $600. That would make its allowance balance 0. And then you need to put in another $1,700 as credit to make it a $1,700 balance. So the way I look at it is you're going to credit it two amounts, $600 and $1,700. And if you do those two, it's $2,300 you're going to need to credit it to make it $1,700. Now, we have said several times that the normal balance in the allowance account needs to be a credit. Why do they have a debit balance in it? Well, their write-offs are debits. So apparently they have had a lot of write-offs, and their write-offs have been greater than what they have put in the bucket for their allowance. So it tends to tell us that they're not putting enough in their allowance account. Okay, so they have to put more than normal, I guess. It's $2,300 they have to put in just to get up to this $1,700 in credit balance, which is the amount which they found when they did their analysis based on the aging of receivables by multiplying the buckets times their expected loss rates per bucket. In the next problem, we're using percent of sales. Now, if you use percent of sales, you don't need to use the buckets, right? Okay? Now, if you use the aging method, which is the second one here, then you have to use the buckets. So the easiest methodology that we have is percent of sales. The first one I'm going to do as percent of sales. You take the 100,000, and if you predict this is half of 1% is going to be bad accounts, then you're recording it like this. This is one of these cases where it's so small, you're wondering, why are they estimating it? Why don't they just wait until it actually writes off? Because for most companies, $500 is not a material amount. I'll just bring that up right now. But following GAAP and putting aside in the allowance for doubtful or allowance for uncollectible accounts, we would do it this way. Look at credit sales, multiply by the percentage, do the adjusting journal entry before the financials go out. Now, if we did it from the aging, we go through, look at our buckets. This again is our total line for accounts receivable. These are the amounts in the buckets. Again, usually you have a 31 to 60 and a 61 to 90 bucket, and it's not combined into one bucket. You multiply, you get the amounts, and you need to have $11,100 as your balance in the allowance for doubtful accounts. So, if that's the case, and you have a current balance of $1,600, you need to put $9,500, you need to put $9,500 more credit in the allowance for doubtful accounts to make it right, or you're going to record bad debt expense of $9,500 to make that thing work. Now, when this is shown on the financial statements, assuming we're going to use the aging approach, and we had $11,100 in our allowance after we adjusted it to equal our estimated uncollectible accounts receivable. When we do this, then our accounts receivable should show up, our net or expected collectability on those accounts receivable is $77,900. You can show this two different ways. You can show it above it like this within the financial statement, the balance sheet, or you can go down and show it this way. But the reader has to be able to see the gross accounts receivable. You could calculate it here, couldn't you? This plus this is the $89,000. They have to be able to see the allowance. It's there. It's there. And they have to be able to see the net value. It's there. It's there. So generally, the reader needs to be able to get all of this information. And you can use a different format. You can use this format. That's perfectly fine as long as the reader can see all three of these numbers or can get to them easily, and they can. Large companies, frankly, large companies, if you go and look at their financial statements, it will be more like this. They tend to say accounts receivable, net of allowance of blah, 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 and then they give the number. Because it saves a line. It saves a line in the financial statement by doing it that way. Next, we're going to look at the effects of write-offs, recoveries, and bad debt expense on our balance sheet. And so it's going to ask us to prepare journal entries and then complete a table. Now this is one where I can't put the description and the journal entries on the same slide, so I'm going to have to talk about which one of these and relates back to these descriptions. The journal entries relating back to the descriptions. If you print it out, it'll be better and make more sense to you. The first one is billing the accounts receivable. So what you're going to do is you're going to record accounts receivable and then you're going to credit service revenue. Now, in a previous chapter, we called this accruing. Okay, accruing, an accrual for revenue, because the cash has not come in yet, and we called it an accrual entry, and that's proper. I don't know why we are getting away from that terminology in this chapter, but we are accruing revenue. We haven't received it yet, but we've done what we need to do to say we have earned it, so we're going to make it show up in our balance sheet as a receivable, but on our income statement it's going to show up as revenue. And the next one is a write-off of a particular account. So if we are using the allowance method, we are putting it in bad debt expense. We are crediting the allowance account, and it's already recorded as bad debt expense whenever we were preparing our financial statements. So when we write it off, we don't put it as bad debt expense. We've already recorded that expense. Instead, it goes into the allowance for doubtful accounts. Let's say we collect someone's account and we've already written them off. What you have to do is reinstate the accounts receivable. That's this one. You are creating the accounts receivable balance. We remove the accounts receivable balance when we did a journal entry like this one for $900. We need to reverse that journal entry and put it back in the account and then collect the cash. If we don't do it, we'll end up with an accounts receivable with a credit balance and we'll send them a check. We don't like to do that. The last one is recording bad debt expense. This is just a journal entry that you get the hang of and you just kind of memorize it. Bad debt expense, debit, allowance for doubtful accounts, credit. What is allowance for doubtful accounts? It is also sometimes called allowance for uncollectible accounts, and it is a contra asset. It is a contra to accounts receivable. Has to be shown all the time. We show accounts receivable. It always has a credit balance. But this journal entry, you just memorize it because it's the standard journal entry which you end up doing as an adjusting journal entry before the financial statements are completed. Now, this discusses the impact that it has on our financial statements, on the balance sheet and the income statement.